is now joining us, Managing Director and Chief Economist at DBS Group Research. Taimur, good to have you with us here. Thank you for your time. The rally's been pretty good in 23, Taimur. Just big thoughts for 24. I mean, top three big thoughts. Briefly, go on. Morning.
Right. Good morning. What goes down has to come up. So we saw in 2023, I was hearing some of the numbers you were citing in terms of dramatic developments and impressive returns in various parts of the global economy. But the really impressive parts were the ones that were beaten down in 22, had room to recover in 23. Turkish dollar debt, who would have thought that would be one of the best bond performers in the world, uranium prices, cocoa prices. So when we look into 24, I think we need to also think about things that did very poorly in 23. Do they have room to run in 24? And I think therein lies the most contrarian view of the world, which is China. We are reading story after story in the last 1 week or so about investors withdrawing huge amount of capital from China. We haven't seen any good news out of the China macro over the last, I can't even remember when there was a good piece of news out of China macro. But that tells me that looking at the track record, whenever something is beaten down a lot, there was always the bottom fisher. I would expect the China equities to surprise us, or at least there to be room for surprising us in 24. But the second one is that something that comes in with a lot of momentum tends to carry that momentum at least for a while, even in the new year. So there lies I suppose, the bullish view on both the U.S. economy as well as the Indian stock market. I heard your colleagues talk a little earlier about how in late 23, we're finally seeing substantial amount of ETF money, substantial amount of active portfolio money being allocated to India, which was quite not the case in 22. 22 and early 23, Indian rally was driven by local investors. Now we're beginning to see foreign participation. I expect that momentum to continue through the first 2 quarters of 24, if not longer. And the U.S. economy, look at the Atlanta Fed now casting for the fourth quarter. This was supposed to be the slow quarter after the blockbuster quarter in July, September. Turns out we're going to have well over 2% in the fourth quarter of 2023 as well. So the U.S. economy will step into 24 with an absolute Goldilocks mix, slowing inflation, likelihood of interest rate cuts, but not much slowdown in the real economy. So China undervaluation, momentum for Indian stocks, momentum for the U.S. economy would be my 3 big themes for 24.
So talking about the U.S. economy, there is a lot of euphoria surrounding the extent and the timing of Federal Reserve rate cuts. Goldman Sachs is predicting that the first rate cut could come in as early as March. Where do you stand on that for 2024, the timing and the overall quantum?
Right. Our view is that the expectation of the U.S. rate cuts could be a bit premature. There's been substantial easing of monetary conditions around 10-year bonds rallying in the last couple of months. So in a way, the market has already eased monetary policy for the Fed, gotten a bit ahead of itself in my view. And the Fed, as it steps into 24, sees overall growth momentum being very strong, very mild signs of slowdown here and there, would have absolutely no urgency to cut rates unless we see some major news in the next 2 months of delinquencies for consumers. So you need set of bad news for the Fed's hand to be forced in March of 2024, or else, in our view, rate cuts are going to be backloaded in the second half of 24.
Taimur, hi. Good morning and season's greetings to you. Sometimes you get a little worried when you can't think of the risks or the negatives. Like you're saying, it's a pretty much a pretty Goldilocks scenario as we set into 2024, right? So, barring geopolitics, is there anything else? Any risk that perhaps we should remember?
Yeah, I think that it is highly unusual for a cycle where rates are hiked of this magnitude to end without any financial stability issues. We saw a little harbinger of that about 9 months ago when regional banks in the U.S. came under stress because of duration mismatch. I think that there is a vast swath of the private capital markets, and by that I just don't mean the U.S., I also mean India, where there is a risk of duration mismatch, where people have borrowed in low interest rate times are now facing substantially higher rate times. And I worry that some of those financial accidents could manifest. And that, of course, talking about forcing the Fed, would force the Fed pretty quickly. And therein lies the two-pronged approach of monetary policy in the U.S. The quantitative tightening aspect of the interest rate. We can probably see some degree of communication or quantitative tightening if financial stability issues were to be mind in the coming months. So that's one big risk, no question about that. Second issue is inflation. Right now, everything looks wonderful. Commodity prices have come down, services prices have stabilized, but I think there's still a lot of tightness in the economy in terms of supply demand of labor. There's a lot of tightness in the U.S. economy in particular with respect to extra liquidity. Despite a year and a half of quantitative tightening, there's still a lot of liquidity. Those things can go ahead and spoil the inflation picture. One should not be shocked about that. So that's another risk in the horizon.
All right, Taimur, great to have you with us here. Thank you very much for your time. So that's the global picture and some risks, perhaps, which could play out, which are not in the price right now.